In this recording, we're going to look at Chapter 3, Question 3, and we're going to work through the transactions through December 1, and then the next recording, I'll do these adjusting entries at December 31st. So let's review a little bit. We know that we have two accounting equations, assets equal liabilities plus stockholders' equity. And then if one side of the equation goes up, the other side goes up too. And that our debit credit rules are if assets go up, we call that a debit. If the other side goes up, we call that a credit. And then likewise, if assets go down, the other side has to go down. And then we reverse the debit credit rules. This is a credit. This one's a debit. I have already set up my headings for the horizontal model for this problem. Even though it did not ask us to do that, you still need to go through this thought process. So we'll do it visually. I just happen to know these are going to be the assets: cash, accounts receivable, prepaid rent, supplies. There are three liabilities: accounts payable, unearned revenue, and salary payable. And the two stockholders' equity, common stock, retained earnings, and then we'll list the various accounts that affect retained earnings, the revenue, expense, dividends. And then this cash account will identify whether it's an operating, investing, or financing activity as we go through. The other thing as we do this is that we also from the get-go want to analyze every transaction, because company always receives something and gives something up for it to actually be an accounting transaction, or sometimes we call it an accounting event. Okay, so here is question 3. Of course, you're going to have different numbers than this demonstration problem. But on January 30th, they established the business when it acquired $45,000 of cash by issuing stock. So let's look at what did the company receive? Well, they got money, right? They received cash, $30,000 of cash, and they gave up stock certificates. The stock certificates will just say that's common stock. So cash came in of $45,000. We're going to put that in the bank, right? And we gave up stock certificates worth $45,000 as well. Then, of course, in the analysis part, we have to identify what are these things. Well, cash is an asset. It's something we own. And common stock, well, that's part of stockholders' equity. Okay, so if I go back to the horizontal model, in this transaction, right, cash is going up $45,000. And then common stock is also going up $45,000. And that keeps this account in balance. This side goes up and that side goes up. And then I can apply my debit credit rules. Assets go up, that's a debit. And then over here, this side goes up, it's a credit. So then we would write out our journal entry, and I'm just going to go ahead and show you the solution, right? They put transaction 1, the date's January 30th. Debits get written first. So cash, there's my debit of $45,000. And then you're going to indent for the credit. The credit gets indented because it's always on the right, right? Debits are left, credits are right. If you forget that, just think of Washington, D.C., so debit left, credit right. So debits come first and then the credit. Okay, and so they wrote that out: cash, debit, common stock, credit, $45,000. The last thing I want to go ahead and do is this cash flow activity. This is cash coming in from common stock, right? We finance assets with stock, so that is a financing activity. And I went over these 3 categories in the prior lecture video. So if you want to refer back to that, if you didn't listen to it, go back and look at that. But if I have a cash flow, cash coming in, it's from financing with common stock. That's a financing activity. So I'm just put FA there. Okay, let's go look at our second transaction, February 1, paid rent for office space for 2 years, $24,000 cash. Okay, so let's look at what did we receive? Well, we received rent in advance, right? And we gave up cash. So we've given up cash. In exchange, we've got rent for 2 years. Since we have not used this rent, this is an asset. It's something I own. I haven't consumed what I own yet. Cash is also an asset. So I've got rent in advance, and we're going to call that prepaid rent. Will be the account name. And then cash will go down. And by the way, you'll find account names in your textbook. If you get confused, just go back to your book. So if I put that on here, cash is going down $24,000. Prepaid rent is going up $24,000. Let me do that and then down. Sorry, those are a little close together. Okay, so nothing happens on the other side. It's an asset exchange. We gave up cash in exchange for prepaid rent. Assign your debits and credit. This side goes up with debit, so that makes the prepaid rent a debit. It goes down with credit, so we're going to credit cash. So then we go back to our journal entry, and I can see that the debit is prepaid rent. The credit is to cash. And I just write it out in the journal itself. Okay, let's go to the third transaction. They purchased $3,200 of supplies on account. On account means they are charging it to their account with the supplier, right? They'll have an account with the supplier, and they bought $3,200 of supplies on account. So what did we get? Whoops. What did we get and what did we give up? Well, the company got supplies, right? They did not pay cash for them, so they owe money for the supplies. So they got supplies in exchange. They kind of did an IOU to the supplier. We owe you money. So supplies, then you got to identify what kind of account is this. It's something we own, so that's an asset. We owe for supplies, and we're going to put that in an account payable is the account we're going to call that. It's a payable because we're going to pay money in the future. So that's how you remember payable from receivable. We will pay money so in the future. So it's an account with our supplier that we're going to pay money for. And that is a liability. Okay, so we have an asset and a liability. Let's go to our horizontal model. So we have supplies of 3,200 going up, right? This is going up, and we owe money. That's our account payable. It also is going up. So this side goes up 3,200, and that side goes up 3,200. Assign our debit and credit. Assets go up with debits, liabilities go up with credits. So now we have figured out what account are we going to debit, what account are we going to credit, and then you're going to go to your Part A journal and you're going to type in supplies is my debit, 3,200, indent, accounts payable is my credit, 3,200, right? And debits and credits always equal. All right, next one, July 1, received $24,000 cash in advance for services to be provided over the next year. We haven't provided the services yet. We're going to provide them. So, there we go. So, let's stop and think. what did we get? Well, we actually got $24,000 cash, which is money we're going to deposit in the bank. What did we give up? We have not provided services yet. We owe services. We promise to provide services in the future. We're promising to provide these services. Okay, so that account is called unearned revenue. It is not revenue. Revenue is when we have provided a good or service. Unearned is when we have not earned it yet. We have not provided the good or service yet. Identify what this is. Cash is something we own. That's an asset. If we owe services, if we owe anything, whether it's owe cash or owe a service, that's a liability. And then we'll go assign our debit credit rules. So cash went up. Unearned revenue also is going to go up. So let's go back and put that in. So we've got cash, 24,000. And in exchange, unearned revenue of 24. So we put it on a horizontal model. You may do this in your head, or you may find you still want to write out this horizontal model until you get really comfortable with arriving your debits and credits. Now assign your debit and credit. Assets go up with debits, so we're going to debit cash. Liabilities go up with credits. So I'm going to go to the journal, debit cash, credit unearned revenue. And that's exactly what they've done. They debited cash and they credited unearned revenue, writing it out. Okay, July 20th, they paid $1,500 of the account payable from April 10. Right? Remember, on April 10, we bought supplies on account of $3,200, and we're going to make a payment of $1,500 for that. So let's go look at what did we give up and what did we receive. Well, the easy one is figuring out what we gave up. And we gave up cash, right, in the bank. And what did we receive? Well, we actually get a reduction in our account payable, right? Over here, our liability for account payable went up because we owed money, so the payable went up. And here what we're getting is for that liability to go down. So we give up cash and we get a reduction in our account payable. So here's how that's going to look. Cash is going to go down $15,000, and then account payable, $1,500, sorry about that, and account payable will go down $1,500 as well. Let's get rid of that 10. So reduce $1,500, reduce $1,500, and then so now, if I were to draw my line, like 32, we would have a balance of $1,800 that we still owe on our account payable. But we're not doing that. It's not asking us to keep a balance at this point in time. Okay, assign debits and credits for this journal entry. This side goes down with a credit, and this side goes down with a debit. So my debit is to accounts payable, my credit is to cash. And let's go look at that. So here's my journal entry, debit accounts payable, credit cash. Okay, and I'm going to stop and I'll pick this up in the next video.